Hey everyone, welcome back to Corporate Decoder. Today, EQT Infrastructure Company L.L.C just filed its quarterly report, a 10Q for the period ending the 31st of March 2026, and I am seeing some aggressive growth and investment activity. Quick note, this is not financial advice. Just my take on public filings for educational purposes. This company is making some big moves with new investments, and the financials really show that acceleration. Alright, let's dive into what EQT Infrastructure Company L.L.C has been up to. This report covers the first 3 months of 2026, and a lot has happened since their last filing. Think of this as a snapshot of their financial health and operational progress. First, let's look at their balance sheet as of the 31st of March 2026. This shows what the company owns and owes at a specific point in time. Their total assets have jumped significantly to over $417 million. That's a massive increase from just over $9 million at the end of 2025. A big chunk of that asset growth is in their investments, which are now valued at over $193 million. This tells us they have been actively buying up assets. Remember, these are investments held at their estimated market value, not what they originally paid. They also have a healthy amount of cash and cash equivalents, over $216 million. This is crucial for having the flexibility to make more investments or cover any unexpected expenses. It's a huge jump from the just $1,000 they had at the end of 2025, indicating they raised a lot of new capital. So their total assets are now over $417 million, a huge leap, showing a significant expansion in just 1 quarter. What about their liabilities? What they owe, those are around $9.3 million, which is pretty manageable compared to their assets. This leaves them with net assets of over $408 million. This is the value that belongs to the owners, the shareholders. It is a massive increase from just $1,000 at the end of 2025. Digging into the specifics of their ownership, they now have over 11.8 million Class A shares outstanding, which is a huge number compared to 0 at the end of 2025. This clearly shows a period of major share issuance to fund these new assets. Now let's talk about how they performed financially in the first quarter of 2026. This is their income statement showing revenues and expenses. They earned nearly $1 million in investment income, mostly from interest. This is from their cash holdings and perhaps some of their shorter term investments. Total operating expenses were about $7 million for the quarter. This includes management fees, legal and professional fees, and other administrative costs. Interestingly, a significant portion of these expenses, over $5.2 million, were reimbursed by the manager. This means the company is not shouldering the full cost of some of these expenses, which is a nice break. After accounting for all this, they show a net investment loss of about $761,000. This might seem concerning at first glance, but for a company actively acquiring assets, it is not unusual. They are investing heavily, and that often means initial expenses outweighing immediate returns. But here is where it gets interesting. They also had a huge increase in unrealized appreciation on their investments, over $23 million. This is not money they have actually received yet, but it's the estimated increase in the value of the assets they own. This is why their net increase in assets from operations is over $22 million, despite the initial investment loss. They are essentially growing on paper due to the rising value of their holdings. This statement tracks what happened to the company's net assets over time, showing where money came from and where it went. The biggest story here is the massive inflow of capital from issuing new shares. For Class A shares alone, they received over $300 million. Add in other share classes and you see hundreds of millions coming in. This directly funded their aggressive investment strategy. This statement tells us about the actual cash coming in and going out. For the first 3 months of 2026, they used over $108 million in operating activities. This is largely because they acquired portfolio companies costing over $111 million. This makes sense, they are spending a lot of cash to buy assets. On the financing side, they brought in over $325 million from issuing shares. This is the cash inflow that fuels their operations and investments. So after all the activity, their cash and cash equivalents increased by over $216 million. This confirms they are in a strong cash position after this quarter of intense activity. This is where we see their actual investments. This is the core of what the company does. They have significant stakes in companies like Constellation Cold Logistics, valued at over $29 million. This is in the logistics and cold storage sector. Another big one is Madison Energy, focused on solar and energy storage, valued at over $41 million. This shows a clear interest in renewable energy infrastructure. They also have a large investment in McNair, a global data center provider valued at over $30 million. This diversifies their portfolio into technology infrastructure. In total, their portfolio companies are valued at over $193 million. The original cost for these investments was over $170 million, meaning they have seen a good increase in value on paper. They also hold over $108 million in a Morgan Stanley money market fund, and a similar amount in a JP Morgan money market fund. These are very safe liquid investments, totaling over $216 million. This cash is likely set aside for future investments or to manage liquidity. It is important to note where these investments are located. A large majority, almost 87%, are in North America, with about 13% in Europe. This gives us an idea of their geographic focus. The notes are where the really detailed explanations are. This company was formed in June 2024, so they are relatively new. They operate as a holding company aiming to acquire, own, and control infrastructure, related businesses through joint ventures. They kicked off their main operations in February 2026, which is very recent. This section explains how they value their investments. They use a 3-level system. Level 1 is based on observable market prices, Level 2 uses other observable data, and Level 3 relies on unobservable inputs, meaning more estimation and judgment is involved, especially for their private investments. Most of their portfolio companies, the ones not in money market funds, are valued at Level 3. This means their valuations are based on their own models and assumptions, not directly observable market prices. This is common for private equity or infrastructure investments. Here we see the breakdown of their investments by these valuation levels. All their portfolio companies are listed as Level 3 investments, valued at over $193 million. The money market funds are Level 1, meaning they are valued based on their readily available market prices. This table gives us more insight into those Level 3 valuations. They use methods like market comparables and discounted cash flows, which involve inputs like EBITDA multiples and discount rates. For example, they use an enterprise value to EBITDA multiple that ranges from 12.2 times to 18.5 times. When they use discounted cash flows, they factor in a weighted average cost of capital, or WACC, which ranges from 9.2% to 13.6%. These are the kinds of assumptions that drive the estimated value of their private investments. This company has a significant amount of expenses that the manager agreed to reimburse. Look at this table showing amounts subject to recoupment. For the period ending the 30th of June 2024, the manager reimbursed over $1.7 million in expenses. This pattern continues. By the 31st of March 2026, the total amount of expenses reimbursed by the manager reached over $12.7 million. This is a substantial amount and shows the manager is supporting the company's initial growth by covering many of its operational costs. This section details the share activity. In the first 3 months of 2026, they issued over 15.2 million new shares across various classes. This directly corresponds to the massive capital raise we saw earlier. They have a share repurchase plan, meaning shareholders can ask the company to buy back their shares. However, they do not expect to do this until after the 30th of September 2026. These are events that happened after the 31st of March 2026, but before the filing date, on the 1st of April 2026, they sold over $124 million worth of investor shares. And then, on May 1st, they accepted subscriptions for another almost $90 million. This shows their fundraising efforts are continuing strongly into the second quarter. They also amended their limited liability company agreement to create new classes of shares, like Class MI shares, and adjusted management fees for some of these new share classes. This shows them refining their capital structure as they grow. Now let's get into management's view of the company's performance. They emphasize that they are a relatively new company formed in 2024 and began their main operations in February 2026. Their goal is to acquire and control infrastructure companies, primarily through joint ventures with EQT, their sponsor. Management acknowledges the current global uncertainty due to inflation, interest rates, and geopolitical events. They are actively monitoring these factors for their impact on the business and their portfolio companies. This is a standard but important acknowledgement of external risks. In the first quarter of 2026, they raised over $325 million in investor shares. This capital was used to acquire 8 portfolio companies for over $170 million. Here is a look at how their share classes performed in terms of total return for the quarter. Class E shares, for example, had a return of 7.75%. These are figures based on their estimated net asset value, not necessarily cash returns. They list their 8 portfolio companies. We saw many of these in the schedule of investments: Constellation Cold Logistics, Madison Energy, McNair, and others in the energy and environmental and technology sectors. They also acquired interest in Steel River and Lumos in April and May 2026, showing continued investment activity past the reporting period. As we saw in the income statement, they earned almost $1 million in interest income for the quarter. Total operating expenses were around $7 million, with over $5.2 million of that reimbursed by the manager, as we discussed. The management fee for the quarter was about $104,000. This is paid to the manager EQT Partners Inc. for their services. And then there is the performance allocation, which is a significant expense, nearly $2.6 million for the quarter. This fee is paid to EQT AB Group and is tied to the company's investment performance. It is a way for the sponsor to share in the profits. They also incurred offering costs, which are costs associated with raising capital. These are being amortized over time. The total deferred offering costs are about $1.7 million. This section talks about the risks they face. They highlight the risk associated with valuing their level 3 investments. A hypothetical 10% decrease in the value of these assets could lead to a significant drop in their reported net assets, over $19 million. This underscores the estimation involved in valuing private assets. They also face risks from fluctuations in foreign exchange rates since they have investments in Europe. A 10% strengthening of the US dollar against foreign currencies could lead to a small net decrease in assets, around $18,000. After considering hedging, interest rate changes can affect the value of their investments and the cost of any future borrowing. As of the 31st of March 2026, they had no debt, so this risk was minimal for them at that moment. Finally, the exhibits list all the important legal and corporate documents related to the company. These are the foundational agreements that govern how the company operates. This exhibit refers to their second amended and restated Limited Liability Company Agreement, which is a key document detailing the company's structure and ownership. And this one is the amended and restated management agreement with EQT Partners Inc., defining the manager's role and responsibilities. Now, looking at this filing holistically, EQT Infrastructure Company L.L.C. is clearly in an aggressive growth phase. They've raised a tremendous amount of capital and put it to work acquiring a significant portfolio of infrastructure and technology assets. The fact that much of this capital is coming from new share issuances is a key driver of their increasing asset base. Their strategy relies heavily on the manager for sourcing and valuing these deals. And this is reflected in the performance allocation expense. The significant amount of expenses reimbursed by the manager is a major positive, reducing the immediate cost burden on the company as it scales. The main risk I am watching is the valuation of their level 3 investments. Since these are not publicly traded, their reported value depends on management's assumptions. While they have a structured process for this, a downturn in the broader markets or a misjudgment in their assumptions could significantly impact reported net asset value. What I am actually looking for next is how these newly acquired portfolio companies perform and contribute to future returns. The initial capital deployment is impressive, but the long-term success will depend on the operational execution and value creation within these acquired businesses. Alright, that is my take on EQT Infrastructure Company LLC's latest 10Q filing. What do you think about their investment strategy and financial results? Let me know in the comments below what you are watching in their future filings. If you found this breakdown helpful, consider liking this video and subscribing for more in-depth corporate filing analysis. The research tools I use are linked in the description and they help make this channel possible. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.